So it's one thing for you to be managing treasuries and people's assets and trying to figure out what's going on over the long term. What about your family? Are you telling them, hey, be careful about how much debt you're taking out now, or have cash at your house? Like, how are you in a time of chaos instructing those that are closest to you?
Well, we at Hoisington Management eat our own cooking. In other words, we don't do one thing with client money and something else with our own money. So we have been heavily investing in longer term, high quality debt. But I have been recommending to my children and to friends that this was not a time to take on debt. And unfortunately, our corporate sector has done exactly the opposite. The corporate sector is more heavily leveraged now than they've ever been. And last year, we saw a record increase in corporate debt. And by the way, capital spending in real dollars was unchanged. So we had a huge increase in debt, but no increase in capital spending. And what they were doing is they were buying their shares back. They were actually leveraging the balance sheet. And
can you explain what that means? So I worked at a company where they did that a lot, but a lot of people don't understand. I mean, because it buoys the stock price. So if you're holding shares, people feel like you're making money that way.
They do, but it makes the bank. And by the way, the argument was that their earnings were secure and that their cost would be low. Well, their earnings are not secure, as we've seen. The coronavirus has severely shaken the income stream for many. And in addition, as the risk of deflation has emerged, the treasury rates have come down and the corporate yields have risen. And so one of the great names in corporate finance said that the key to sound financial management of a corporation is to sell more of your shares when the share price is high and to buy the shares when the shares are low. But what were firms doing the last several years? They were buying their shares at a high price and issuing debt. And the man that said that was the late Benjamin Graham, who was the father of investment analysis. The key to sound financial management is to sell your shares when the price is high and then to buy the shares back when the price is low. They did exactly the opposite.
And this was heading into coronavirus, that they were not in strong financial positions. So when this goes on, then how does that play out? Then what happens to a company that's taken on that debt?
It made them very vulnerable. Now the corporate sector is very vulnerable, and they're going to find that the cost of borrowing is going up to them rather than down. And in addition, what they're going to find is that their earnings stream and their cash flow stream is much weaker than they had assumed. This was an event that came out of left field.
So if you're investing in treasuries that are 7 years out, I mean, who was it? Khrushchev? We've
been out longer than that. We've been out close to 30 years.
And I was looking up your numbers. I mean, as far as I can tell, you guys have returned over and over and over again, positive returns, doing very well. When you look out and you're buying treasuries that are 30 years out, Khrushchev wouldn't even look more than 5 years out for his plans. How do you have confidence in that distance of time?
Well, we don't. We only have confidence in the next several years. In other words, our investment strategy is for the next 3 to 5 years. And so we're not buying them to hold to maturity. We're buying them as long as the inflation rate is going down. The bond market has a very important fundamental relationship that explains the movement of long treasury rates. It's called the Fisher equation. It's one of the pillars of macroeconomics. It says that the risk-free long rate is equal to the real rate plus expected inflation. Now, what's happening here is the real rate is coming down. The growth rate is getting weaker. This expansion that we went through was the worst since the end of World War II. And by the way, I'll just give you a number. From 1790 to the period of high indebtedness in the late 1990s, the economy grew 2% in real per capita terms, which means the standard of living grew 2% per annum. Since then, the last 20 years, the economy in real per capita terms has only grown about 1.1%. We've lost 1/3 of our growth rate during this period of high growth. And so we saw the real rate coming down, and we saw inflationary expectations declining. Now, if you think about that equation, the government bond yield is equal to the real rate plus expected inflation. The recession is going to make the real growth rates lower. So one of the components of the Fisher equation is going to be pushing downward. The inflation rate is going to go negative into deflation, which suggests to us that the entire Treasury yield curve is going to press down on the zero bound, and that it's going to be stuck there.
For years.
It's the way it looks at the present time. But as I said, we're in the investment management business. We're going to look at everything that's being done. One of the things that is being advocated right now is that the country engage in money printing, something called modern monetary theory, which is neither modern nor a theory. It is usually using a worthless item to pay for existing bills. And so we're in a difficult situation here. Deflation is a risk. And so there is a clear possibility that the Federal Reserve Act could be rewritten. And as I said, the Bank of England has already stepped into the Rubicon.
And so when you look at the idea of individual citizens getting a check, we just $1,200 out to people making under, $120,000 a year, and then potentially now $2,000 more coming in next month per taxpayer. What does this do to the economy when you're taking money and you're giving direct payments directly to consumers?
The problem, it allows the consumers to get by. But here, the government issues the debt. The debt will not stay at 107% of GDP. It's on the way to 125 to 130. And if you overuse the factor of production, you get less output. For example, we had a $2 trillion stimulus package in 2009. Shovel-ready projects. You remember that?
Yeah.
And it was going to be financed by the Federal Reserve, quantitative easing. We were told it was going to lead to higher inflation, lower dollar, stronger economy. Did any of that happen? No. We had the weakest recovery since the end of World War II. So what this does, it allows those families that have lost income to continue spending. But the debt is still there, and the debt will serve as a overhang on growth.
Yeah, that current spending didn't result in better producing in the future. It just kept you alive.
All it did is replace what would have not been spent. It allowed people to pay their bills. That's why I said it was popular. Why it was humane. It almost gave there's no doubt that it should have been done. But I, as an economist, have to analyze the longer term consequences. So I acknowledge that it was politically popular. I acknowledge that it was humane. It was the thing to do, but it nevertheless has a negative economic consequence on growth